Hi, Janet. Thank you so much for coming to the Investor Talk. How's it going?
Hi, Max. Thanks for having me. Well, thanks. How are you?
Oh, good. Thank you so much for coming. As we start, would you like to give a short intro to yourself?
Yeah, absolutely. So, my name is Jannat. I'm based in London and I'm an investor with Forestay Capital. And my background is a combination of investment banking, venture capital investing before, and I have operational experience inside B2B software companies. And I've returned to investing about 6 months ago to invest in B2B software companies.
Excellent. So you invest in B2B software, but in terms of stage geography, where are you?
So I invest across Europe and UK, depending on how you classify Europe these days. And we at Forestay we invest in Series A, B, and C B2B software companies. So broadly, this translates to companies with recurring revenues of maybe 2 to 10 million in annualized revenues. Although we're flexible about what that means in practice, but usually that's what Series A to C means for us.
So it's already on the growth stage,
That's
more,
right.
yeah, where data are more relevant in terms of, more tangible. Let's put
And
it
we
this way.
have some, yes.
What about the ticket size? Which kind of size of the round are you looking for to invest?
Well, from our perspective, we would probably write a first check into a company of about 15 million USD euro. I guess they're the same these days. And that would give us room to follow on. We are pretty flexible on what that means in terms of leading around, co leading around, syndicating, following, as long as we have permissions to be hands on with the company, have information rights, and can be value add.
I like to ask the investors what actually they look at when investing. Because when I talk to investors, for example, in the very early stage, pre-seed, seed, or angel investing, where data are not there at all, they are more untangible, the tangible data. Uh, Actually, as you invest from A, we're supposed to have some kind of revenue already. Which kind of data do you look at the most, and how, in terms of balancing, how important is the traction versus the founders? Because you already have data, so you can understand better how they are.
Yeah, it's a really good question, and it's hard to always balance and get it right. I would say, you know, we're investing in people who are building businesses, so the people still matter, the founders still matter. Sometimes in the growth stage, the founders may need extra executive support, so you also have to make an assessment of who else might need to be hired. Would the founders necessarily be the CEO? Do they want to be the CEO equivalents going forward, or would they rather be CTO and delegate that? So you kind of have to make an assessment of what they would be like for growth. But in terms of data, we do have more data points to determine traction. And I would say that there are kind of two lenses when you think about B2B software in particular, because you could have something that's more of a product led growth motion where, not to say the product sells itself, but it's
Yeah.
got that still, even though it's B2B software, it's got that kind of download and go attitude. And then within the product, the stickiness and a lot of the experiences around the product itself. And then you have more of an enterprise sales led motion, where while the product will be pretty detailed and heavy and likely quite expensive and more enterprise grade, you have the sales motion, which where you can measure more sales efficiency. So I'd say depending on the nature of the product concern, the nature of the data and the expectations around the quality of that data and how it's evolving over time differs. So for example, in a product led growth motion, you'd probably want to see the product analytics data in terms of monthly active users, weekly active users, and seeing that it's sticky and still delivering retention from usage. And then on the enterprise sales led motion, you might get a little bit more into the sales economics, in both cases you have unit economics, but the profile is slightly different. So I would say data wise, you probably want to form a view on what the unit economics look like. And then in terms of, say, more traditional financial data, it also depends on how deep the tech is. Deep tech is probably a sector in and of itself, but you might have a company that's more R&D driven in terms of where they're spending money, and therefore where they would spend investment capital or primary capital that comes in. And then on the other hand, you'd have one that's maybe more go to market led, and therefore they index their spend a little bit more on sales and marketing and customer success, with a view to fueling that engine and therefore growing in that direction. So there's also a calibration of understanding where they sit in terms of the development of the technology and how they're spending it, to also form a view of how investment proceeds would be spent going forward. So I'd say these are some of the things that, in a quick scan, I'd want to understand pretty quickly so far as financial data points are concerned and traction is concerned, because that's kind of what Series A, B, and C
Yeah.
investors get that the seed investors don't really.
I mean, he had the luxury of the data, but you need to understand them and be the
Yes.
proxy to the future, right? Uh, in terms of investing, I remember before the pandemic when things were different. Face-to-face meeting was still a must that has to happen before investing. Now, many investors, they tell me they're absolutely confident to do everything online up to sending the money, wiring the check. Is something that applies to you, to your fund, or you still want to meet them?
I think I would still want to meet them. I think the earlier conversations can continue to happen on video conferencing, but there is an element of relationship building, and just as much
Yeah.
as the company is pitching to an investor, the investor and or us, we're also pitching to the company. We're also saying, pick us, trust us,
Yeah.
select us as your board members as well. So I think building that relationship goes both ways. And while yes, it has been done, and the pandemic clearly proved it, that you can do transactions. We know just how many transactions took place in that
Yeah.
time. The market was what it was. But I think having now once again the luxury of being able to travel, being able to do things face to face, while not the whole process needs to happen face to face, relationship building and building that trust, particularly when the world is quite so digital, I think that adding the personal touches works both ways. So I would say, at least on my behalf and on Forstay's behalf, we still like having at least face-to-face interactions in the kind of far end of the process, and making sure we meet.
I mean, I believe face to face gives you something different. I don't know, the testing, what we call chemistry. You understand better if you can actually work with these guys, or
Yes.
if they can work with you, right? Uh, After investing, how do you like to get in touch with them unless you have the board? But if you're not in the board, they should, I don't know, report to you any quarter, for example.
Yeah, I'd say information rights are important because you know a lot of the work, quite frankly, would happen outside of the board meeting. Sometimes a board meeting might just be a forum to
Yeah,
um, hear the latest, and usually
okay.
hear what's been prepared in a board deck, a bit like being pitched again. So a lot of the realities can also strike outside of the board meeting, and a lot of the value add happens outside of the board meeting as well. You might not get to the heart of a business challenge or business problem in the board meeting, particularly if they're depending on how big the board is and who are the other stakeholders involved. Um, it can be busy. So I'd say our approach is, yes, we take active governance positions and we ask for information rights, but we also um, provide support outside of the board meeting, so that there are meetings with whoever needs it, CEO, CFO, whatever it takes, based on whatever challenges are usually addressed in the board meeting but handled outside. So I'd say we believe in having more touch points than less, but I also believe that the most important touch points probably happen outside of the formal governance commitment.
Yeah, it's always this way. The board meeting is more the formal part of so many discussions behind the
Yeah.
doors. Uh, Now, from my understanding, you are an hands-on venture capital, which means does work, try to help the funders to move forward, right? Uh, which kind of support do you give to them?
It can vary depending on needs. So every company is different. And you find that companies, particularly at the Series A, B, and C stages, they're going through growing pains of different kinds. It might be that the product market fit that they found at a point in time in one way is not sustained as they go into another market. So it might be helping with market expansion and getting that right. It might be readdressing go to market decisions to make sure that the product can expand into different verticals. It might be hiring in new executives that will give the company more maturity and more bandwidth. And it might be, just sometimes being a sounding board and just letting them know that, um, the growing pains that they're going through are normal, and, they're not alone. So it can be a variety of things to help out with. But usually you find at this stage, one, everyone has growing pains, and two, they're not all the same, but they're all quite interesting cases.
Yeah, that's correct. I mean, everyone is different. Everyone is a different case. Uh, when I talk to, especially when CVC, corporate venture capitalists, they like to put the companies together, which means try to even making them networking. Maybe if someone needs some skills from the other one or sales to each other, this is something that you play in your portfolio.
We're increasingly trying to do it to almost create these support circles, if you will, particularly if heads of product are not well networked with others, or heads of talent aren't well networked with others, or CFOs are not well networked with others, to find them somebody who might be a little bit advanced to them, maybe one stage ahead, and kind of tell them what they need to know, or things like that. So yeah, it really does help socializing both within the portfolio, but also the wider network as well. Particularly because I come in with an operating background, I have a network of people I've worked with on the other side of the table, in-house in companies. So as with my colleagues, they have a similar situation. So we do find people to be sounding boards and to give advice. And you often find that people are very receptive to advice, maybe less so from their venture capitalists, but maybe more so from somebody who's been in their shoes.
That's totally true. Uh, I mean, I don't think pivoting is something that applies only to very early stage startups. Of course, when you are very early, the market is not there. You need to understand the fit. If there is any market, many times you must pivot before failing. But I saw many startups in A, B round still need to pivot. To me, avoiding the failure. Funders, they receive this message from the market very badly. It's kind of defeat. Uh, how do you help them to understand when it's time, when it's time to actually change road because the one is wrong?
Yeah, it's a really harsh reality, right? When you've had success in one direction, and then you have to figure out something else. And actually, in this market right now, you see it a lot, because a
Yeah.
lot of companies may have developed something in a vacuum experiment that we call the pandemic, and then it might not be relevant anymore. Or what may have felt like product market fit under very certain conditions may not be there anymore. So you kind of have to go back to the why of the business and see if it can be readdressed or repurposed into something else. And sometimes it's a question of positioning,
Yeah.
because sometimes you might try and be everything to everyone, and maybe in a pandemic scenario when everyone wants to buy your product, it might work. But then when it comes to retention and engagement of your users, they might not stay with you, or they might not remember you past a certain
Yeah.
point. So I think it kind of starts with reevaluating the strategy and the why, and then rethinking the positioning. It's never an easy conversation, particularly with a founder who might be so close to their product and company that they may, not always, but they may struggle to see another perspective,
Yeah.
or they might struggle to let go of a certain way of doing things. So these conversations are never easy. The best way is to be data driven about it. Sometimes the data of what an alternative reality looks like does not always exist, so you kind of have to approximate and get there. But usually it's about framing it to say, let's test another strategy and let's see what works before we address a new positioning. And you hear this a lot, particularly in this market of, I would say,
Very
Series
common
A.
now.
Hmm.
It's very, very common. But I mean, what I said to them is better to pivot is painful. That's true. Also because founders, I'm a founder myself as well. You love what you're doing. You're very focused. You love the product you have created. And after that, admitting that the product was wrong or 90% wrong, it's not that simple. But, it's better to admit and pivot than die. It would be the pain would be much higher. Uh,
Yeah.
why why have you decided to become an investor? You come from the investment banking and also venture capital as well. But what is driving you to such a pretty it's beautiful industry, venture capital, but it's very tough.
Yeah. I think on some level, every venture capitalist respects entrepreneurs and maybe would want to be one, but doesn't have that idea that they want to pursue themselves. So there's I think for some it's like this belief that venture capital is the second best thing to being a game changing entrepreneur. Instead of being one, work with them.
Yeah.
So I personally like to be around business change and progress, and that there's always a question on whether venture capital is the way to deliver impact, and whether the businesses that you finance are necessarily changing the world. But it's really fascinating to be around people who have such high conviction on their ideas and are really pushing for it. And it's a very privileged and inspirational place to be. Every day you're talking to people who are building, creating, innovating, and it's a privilege to talk to these people and work with these people every day. So I would say I like it because it's very stimulating, and the circle of people you end up surrounding yourself with or exposing yourself to, out of privilege of the role, of course, is just second to none.
That's true. I mean, I find very, very, very fascinating venture capital. I've been there for the last 10 years, coming from private equity, corporate finance, and M&A, which was becoming so boring. That's why I left. It's definitely boring. I loved, I should say. After a while, it was too boring. Uh, let's say if you had three startups very, very much similar to each other, almost identical, but you can only deploy them only one, what's going to trigger makes the difference for you?
I think it comes down to the people who you click with the most, because if all else is equal and you're entering into an investment partnership where you're going to go through ups and downs and highs and lows,
Yeah.
you want to know that, on a human level you connect, and on a human level you have respect, and you're going to spend time with each other so you get along. So I would say all else being equal with three companies, or however many companies say I would optimize for the one with the best fit relationship.
Pitching to a venture capitalist is very complicated. It's not easy stuff at all. It's very, very tough. There is nothing to say. Pitching, especially when they give you just few minutes, and few minutes you must say almost not everything, but convincing them to have a follow-up call. What would you like to see in a pitch? If a founder come to you in a B round, which are because they normally talk, they talk too much, they write too much. What actually would you like to see in a pitch, in a very straightforward pitch, vocal pitch, or in a pitch deck?
Yeah, I think it's an interesting question because usually if your first interaction is pitching, being pitched to, then maybe something's gone wrong because you know it's nicer to have the relationship earlier such that you 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 don't end up in a situation where the first time you're meeting them is them with their PowerPoint and showing you slides and stuff like that. It happens because obviously, particularly at the early stages, that's
Yeah,
how mass meetings and mass pitch events and such take place. But I would say, the key ingredients is why this, why me, why now, what's next kind of thing. And you want to know who you're buying into, what they're building, why it's relevant now, and where they want to take it.
yeah.
And people talk about other things in a pitch deck like TAM and all these things, like total addressable market and these things. You can Everybody can figure out TAM of something, So, when you have limited uh, attention span, I'd say just the kind of the whys, the whats, the hows, the whos, what next. Keep it simple. Um, I I think most people can see through a glossy deck. So obviously it's nice if it's beautiful, but I think that the key messages need to come across, and sometimes people get so passionate about their pitch decks or their pitches that they put so much in that they actually lose the clarity
Yeah, that's
and
true.
yeah.
Sometimes it's overwritten, and yeah, it is. You were mentioning before how to get in touch with investors. I believe community is by far the best way establishing relationship. But in your point of view, if someone comes to you in a very cold email or very straightforward cold approach and pitch, is something that works?
I think it depends on the investor. I know some who don't look at cold emails. I know some who do. Personally, provided the email is not, spammy, clearly sent to 1,000 people, hello, insert your name here in brackets kind of thing. Provided it's, somebody's gone to the effort of emailing me, I would respectfully like to email them back. I think my approach is, subject to it being a normal email, always reply and always say why. Um, and usually with cold emails, the the experience for most investors is that the cold email might not be relevant. For example, if we're a B2B SaaS fund, um, just last week I got an email about an alcoholic beverage company. And you say, great, thank you for the email. And then you kind of send a response saying, we only invest in software. But this happens, right? Where the
Yeah,
cold email is not tailored enough. So while it's nice to get in touch with investors outside of it, and the industry is opaque and people are doing things to change this, so wouldn't say to lose heart on the cold email, but really my advice would be to email the relevant people, personalize it to show that it's relevant, maybe refer to some of the portfolio companies of theirs that resonate with you, and why you'd be relevant, add on to their portfolio in theory, or even about the VC as an individual, like why you want to work with them, why you want a meeting with them. And you usually find that if you personalize it well, they will reply, even if it's a cold
Yeah,
email. So it's about being thoughtful. And I know that founders are really time poor, and it's easier to find some sort of mailing list and BCC everybody and say, hi there, I'm raising. But the conversion on that is going to be so poor. And
yeah, it is.
maybe maybe you won't even want the investors who reply to that. I don't know.
That's correct. Uh, I mean, the amount of data now that you have, they sell you emails from everywhere. I don't know how many emails I receive per week. We had this huge data of investors. Probably they put everything in one basket and they just send an email. Let's see what's going to happen. Anyway, you invest in SaaS. How important is the IP for you?
It matters. I think it matters to different degrees. I mentioned it before, but obviously there are different grades of technology. So there might be something that's over indexed on R&D, and knowing that you can't be everything all at once.
Yeah,
If you've invested a lot in R&D, maybe you don't have as much commercial traction, and vice versa. If something is an easy sell, maybe it's not as invested in R&D and over invested in go to market. So it's a fine balance. I would say, there are obviously some SaaS products that can easily be copied and be, one of many. So I would say we're looking for things that are to an extent unique. I don't think most software is irreplaceable, like someone can build something else, but it's about having something that's at least tech defensible. I think defensibility matters. Um, the thing about software is it's usually a relational database with some sort of UX UI on it, but then you kind of, when you break it out, it's you're asking what else. And now what's interesting in this particular moment in time is that the proliferation of AI means that it can in theory be very easy to build a copycat, but also there's so much more you can do with the software now if you enable certain things, predictive analytics, insights, etc. So in the current era, IP or tech defensibility, as I prefer to think of it, matters even more because the barriers to entry have lowered so
yeah.
much.
Let me close with what's going to happen next. Where do you see the venture capitalists deploying the money this year and next year? Let's take away AI because it is what it is. But I'm talking about more the industry, the sectors, than the technology itself.
Yeah, it's TBD and wait and see, but I think there's a pretty big movement now around things like climate software. There's more regulatory demand on disclosure around these things, emissions, scope one, scope two, CO2, greenhouse gases, etc. And it's also kind of where we are in terms of state of the world. And there's probably more investor pressure and consumer pressure on companies to show their metrics. So I would say that there's probably a lot happening in climate software. Talking about carbon accounting, but also other things in climate. You can already see alternative energy markets and alternative energy technologies really getting funding. So there's a lot going on there. I think post pandemic, there's been a lot of push in the healthcare sector, and now you're seeing more AI applications coming in there. So I think healthcare software is an interesting space. And then, without dwelling on AI too much, because obviously everybody seems to be deploying money there, there's landmark, record-breaking kind of rounds happening now. But
Yeah.
on the other side of AI, you also have questions and concerns around data privacy and how that evolves, and cybersecurity and how that evolves. Not to say that cybersecurity is not already invested in. So I think there'll probably be a lot of attention on these sectors, particularly at the enterprise level, such that they can be in a position to adopt AI. So I think these, particularly in B2B verticals, data privacy will be an interesting one. But these are some of the sectors that I'm specifically looking at as well.
Janet, thank you so much for coming to the Investor Talk. It's been an absolutely pleasure for me. Very, very much. Thank you.
No, thank you, Max, for having me. Such a pleasure. Thank you so much.